Hello and welcome to our interview series where we bring you valuable insights from top fund managers across leading AMP. Joining me and my colleague Chirag today is Bharat Lahoti. He's co-head factor investing at Edelweiss Mutual Fund. Welcome, Bharat.
Thank you.
Good to have you here. Now, to begin with, you started with a BE in electronics and technology. So can you share with us what sparked your shift to the equity markets?
So thank you for calling me. And just to give you a sense, equity markets are extremely exciting. If you look at it, it's a market which is very dynamic. It's a market where you actually learn a lot about different industries. It is also a market where you have to mix art with science. So when I looked at my career, when I did my engineering, obviously science was my one of the passion which helped me to actually build a lot of analytical skills. And when then I did my MBA, obviously it added with the finance skill, and consequently I thought it's a good mixture for me to build a career in equity investments. Over a period of time, what we have understood is that as we grow in career, a lot of things merge out. Whether you do science, whether you do finance, everything boils down to a piece of how do you run businesses, how do you analyze businesses. That's what the important aspect is all about. I think the career choice has been very good for me in general.
Bharat, during your time, you have worked with various organizations, and one of the organization is the TE Shaw renowned hedge fund. What were the key lessons or skills did you pick there, and that still shape up your approach as a fund manager?
So yes, so my career, if you look at it, I started as a buy-side analyst, then moved to sell-side analyst, and then again moved to buy-side analyst in DE Shaw. Obviously, over a period of time, I have learned a lot of skills on the fundamental side, quant side, and what I understand is that DE Shaw, apart from what the quant skill which had nurtured more, three, four things which had great impact in terms of how I have worked with the DE Shaw in general. What I've understood is one can work with different data sets. Like generally, when you look at it, most of the analysts work on something called balance sheet, profit and loss account, cash flow statement. There we used to work with different data sets, something data sets which are not known in general in market condition, and you have to work around it. Sometimes it's macro, sometimes it's extremely micro, sometimes it's a very proprietary data sets which we work around. So you create all those data sets and actually try to analyze companies, industries, even countries from that point of view. So that is important aspect which I learned from that perspective, how to use differentiated data sets. Second thing which I looked at it is how do you actually merge stock specific performance to a portfolio performance. Obviously, when you look at it as an analyst, when I was doing sell side and work, we used to look at companies very individualistically. But when I went to DE Shaw, obviously a lot of things were in respect of how do you look at a portfolio level analysis in terms of how the portfolio performance goes around. A lot of risk management practices had been adapted from their set of things. So that is another thing. Third thing which I learned a lot of it is the special situations which happens of like merger, demerger, open offer, buybacks. These kind of trades, how do you analyze those trades in a global context? How does it apply? How can you make money in such kind of situations? That is also an interesting skill set which got added in my DE Shaw stint.
All right, now moving on to the current market conditions. With the recent market correction, do you think the worst is behind us, or should investors brace for more volatility?
Okay, so if you look at market right now, as we are standing today, what we are seeing is that market is going through a cyclical slowdown. It's not a scenario where we have certain event which are large enough. If you look at it, 2008 was a GFC kind of environment where there was some unknowns in terms of what happens when a financial institution collapses. In the COVID times, we had a very different environment altogether. But if you look at it, this correction has been more of cyclical nature, and these corrections do happen quite often time in equity market. It's not abnormal to that extent. And in general cyclical turn down, the market fall between anything between 15 to 20%. What we are standing is around closer to 15%. What we have gone, Nifty has gone down close to around 15%. Similarly, is the NSE 500, which has gone down 15%. So the correction is very healthy from that perspective. Now, going forward, what we see is that nobody can identify bottoms. Neither I'm just saying none of the guys can identify bottom. We don't know where the bottom lies. But what we understand is that this is not a abnormal fall. This is not a moment where we need extra cautious to that extent. What is that's a general market fall given the sentiment around valuation, given the sentiment around the interest rate scenarios, and given the sentiment around the FI outflows which is there. Having said so, what we see is this healthy correction gives an opportunity to actually look from here on market positively. One should not try to find a bottom, whether we will be able to find a bottom, not it's in hindsight only whether we will be able to make it out. This was a very good level to get into or not. But 15% at an index level is a good correction. When you look at stock level, stocks have corrected more than 30%, 35% in many of these stocks. And it's an interesting proposition. One should look market more favorably. The advice to investors in general, what we are giving right now is that stagger your investment from here on. Try to push in more and more money to its equity market in next 3-5 years. Hopefully, you should be able to make more money from here on.
But if you look at the markets, as you mentioned right now, investors should start looking for the 3 to 5 year period. Do you think the valuations have corrected what it was, 2 months or 3 months ago? And this is the right time, and specifically with regards to the mid and the small cap segment?
Great question. If you look at it, whether the valuations have corrected or not, two things have happened in last 2 quarters of earnings. The September quarter numbers and whatever December quarter numbers so far we have got, the earnings have been bit slacked. If you look at it, the earnings have not been in line to the market expectation, and consequently, market have started punishing some of these stocks where the expectation was built in large. Having said so, that's what I was saying. It's a cyclical slowdown. The earnings, I'm just saying, will get rebounded by next year, kind of stuff, which is a possibility. And when we look at it next 3 to 5 years, the numbers would look decent in terms of earnings growth to that extent. That is one thing one should look at it. Yes, valuation in some of the stocks still are very high, but it's also because of the fact that the visibility in some of these stocks are fairly better off as compared to the rest of the stock. Having said so, what we can think about is that can we identify bottom? Answer is no. The time is you start deploying right now, and I'm just saying another 5-10% if market falls, and that is the case, you actually tend to deploy more and more as we could get closer to 20-25% downfall if it comes in, kind of stuff, which is a general cyclical slowdown pit which we can see around it. Unless until there is a macro event or an event which we don't know, which can't foresee, we don't foresee a market falling like 40-50%. That's what we can tell you.
But now coming specific to the factor investing, as a co-head of factor investing at Edelweiss, how could you explain the factor investing in very simple terms? How is it different from traditional investing strategy?
So if you look at what is factor investing, one can look at it. Why do stock prices give you returns? I'm just saying, why do stock prices give you returns? When you ask questions about that, say for example, an iconic company like HDFC Bank, why that company has given you tremendous amount of returns, the answer what you get is that company was growing at a 35% CAGR for many years, then 30%, then 25%, and so on. So long as the company was showing growth, the company was able to actually grow its share prices, or stock prices were able to give return. So basically, the stock prices is a function of how the growth is happening. Now, growth is a characteristics of a company or characteristics of the returns which can be generated. What we tend to say that these characteristics, if you are able to identify, these are called factors. So in factor investing, you actually harness all these factors, whether it's a growth, value, quality, and so on and so forth. For example, if you want to look at it, why post-COVID, many of these companies have given you 100% returns. I'm just saying And the reason is very simple: the valuation were so attractive at that point of time. So valuation becomes a factor to that extent. So these are what we call factors to that extent, and you actually built models around it in terms of how do I find a growth company, how do I find a company which has a huge deep value kind of stuff. So those are things. If you look from a traditional point of view, quant investing is very similar to traditional investing in a format that we are also looking at same data points what a traditional fund manager is looking at it. Just to give you a sense, what a traditional fund manager is looking at it, he's looking at the sales growth, the operating profit growth, the bottom line growth. He's looking at return ratios. He's looking at margins. He's looking at valuation ratio, like whether it's a price to earning, price to book value, dividend yield, and so on and so forth. We are also looking at same thing, but in a more systematic format. For us, all these numbers do matter. A company which is delivering 30% growth versus company delivering 15% growth, we always tend to say that 30% growth is a superior company as compared to 15% growth. Maybe traditional fund managers will say within that bucket, this looks interesting. But for us, it's more objective way of doing things. So that is the only difference. Else, most of the things, if you look at it, it's very similar to the traditional form of investing. It's only where we actually quantify a lot of factors, what we call, or the parameters which a traditional analyst fund manager looks at it.
Right, Bharat, you mentioned you harness all these factors in factor investing, but when managing your funds, how do you decide which factors, which factors deserve the most focus? Like, when is it that you have to play value, momentum, quality, low volatility? So what is it that guides those decisions?
Okay, great question. Again, if you look at it, obviously all factors don't work at same point of time. There are times where quality does well, there are times where momentum does well, sometimes growth does well, and sometimes value. But if you look at historical numbers in terms of how that factors have behaved over last 10, 15, 20 years, you would see actually there are periods where quality low vol has done exceedingly well. These are periods identified when the markets are extremely nervous. When market is going through a correction phase, people are looking for more safety. Generally, quality and low vol does exceeding well at that point period of time. When market is extremely in recovery phase after a downfall, generally the value factors does well. Like what we have seen post-COVID, actually value factor has done very well. If you look at it in Indian context, or whenever you look at it in emerging market context, most of the time what we have seen is momentum factor does very well, and that is a factor which has been more consistent as compared to other set of factors. Because if you look at value factor, out of 10 years, last 10 years, you would see value factor doing 2 years very well. 8 years it is not doing so well. But whenever in this 2 years it does well, it does exceedingly well as compared to other set of factors. While momentum factors is a self-correcting factor, it actually selects stock based on whether it's a price momentum or is it earning momentum and so on and so forth. And consequently, you would see actually that factor is able to consistently deliver earnings over a long period of time. What we have observed in terms of our research is that momentum factor is an interesting factor from an India point of view, where one has to look at it when you look at it from a longer term perspective, this factor tends to actually outperform many other factors over a long period of time. In terms of how to think about factors is don't rely on one single factor, in our opinion. Generally, the way we think about it in traditional investment style, that don't put all your money in one sector kind of stuff. So our advice is generally don't put your all basket in one style or factor kind of stuff. Use multi-factor models which will be helpful for you. Like we speak about in traditional funds, that you buy a diversified fund. So similar is the case in the factor investing, you buy a multi-factor portfolio.
So, Bharat, as you rightly mentioned, could you please explain us, during 2021 period, after that value did well, then later the momentum did well. Then how does this strategy fit into your overall investment framework? Does it change based on these periods, or is it it remains the same?
So the way we think about it is that when we build a strategy, we tend to think about from a long-term perspective. We don't think about from a period-to-period perspective. We don't know whether next year is going to be value factor will do well, or quality factor will do well, or low vol factor will do well. What we tend to see is that when we run a multi-factor model, which is a combination of quality, value, growth, along with momentum, that tends to do well over a long period of time. The idea is to create a consistency of returns as compared to an outperformance return in a certain set of period. There are many funds in the market who are focused towards one set of factors. There are funds which are value focused, there are funds which are quality focused, there are funds which are growth focused. Typically, whenever the factors not working, those funds tend to underperform substantially. For us, the idea is that show more consistency of performance. That would help us to actually build wealth over a longer period of time. So that's what we do. We tend to actually run a multi-factor model rather than concentrating only on single factors. So we were in 2021, we used to have some amount of value orientation. So is the case with momentum. But what we generally see in our multi-factor models, given that the Indian equity market is more tilted towards growth and momentum, our factor exposure is higher towards growth and momentum. That's what we have seen.
Shifting focus to specific funds. So the Edelweiss Aggressive Hybrid Fund, it has performed well since 2021. Can you please share with us how does factor investing contribute to its strategy and success?
So great. So if you look at it, the hybrid basket, within the hybrid basket, Edelweiss Aggressive Hybrid Fund is a fund where we have 75% equity static and 25% debt static kind of stuff. And if you look at it, the debt portfolio is managed very conservatively, where we have a AAA GSEC assets with the duration of average duration of less than 3 years. That's what we do. So we tend to not do too much on the debt side, where we want to keep it very simple to that extent. It gives us a lot of protection to that extent, that we are not doing anything funny on the credit side or on duration side. That's what we want to do. We want to keep it very simple. On the equity side, you want to keep this portfolio as a multi-factor model. And if you look at it, many of the funds in this category have tilted their portfolio towards value or growth or quality, or even towards large cap, mid cap, and small cap. What we tend to do is we want to run it more in a very balanced way approach kind of stuff, where we have a good amount of 30-35% of mid and small cap, and close to around 70% of large caps. Broadly, that is static. And then we have, over and above, we have a multi-factor model where we have a mix of growth, quality, value, along with momentum, which will build our portfolio. In this portfolio, if you look at it, we have focused, because it's an aggressive hybrid category, we have focused more on growth and momentum to large extent as compared to value and quality to that extent. So that's what we are focusing more on.
Bharat, in a very simple layman terms, could you explain that, as you mentioned, you focused on the value and momentum. Can you just explain in very briefly, how do you select the stocks in this portfolio based on these parameters?
Okay, so the models are very simple. If you look at it, it's a very simple context. Just to give you, if I want to run a large cap fund, the universe is top 100 companies by market cap. We collate the entire large cap universe data, where we take out, say, if I want to run a value factor. What is value factor? Value factor is price to earning, price to book value, dividend yield, earnings, EV to EBITDA. Those are the ratios. So what we do is that for all 100 companies, we tend to identify price to earning, price to book value, EV, EBITDA, dividend yield. And then we rank each of these companies based on these parameters, like price to earning. If the Reliance price to earning is X, and HDFC price to earning is Y, and if X is greater than Y, then we say, okay, Reliance will get rank 1 versus HDFC will get 2. And that is how we rank all these 100 companies. And then we select the best 10, 20, 25, whatever we want to select in terms of it. That is what we call the factor portfolio. So That is what a value factor portfolio for price to earning is. Similarly, we can do for price to book value. Similarly, we can do for dividend yield. Similarly, we can do for EBITDA. We can combine all these four factors also together to form a composite value factor to that extent. So that is also a thing which we can do. So that is what we call value factor. Similar, you can do same exercise with growth, where you actually collate growth of all these 100 companies, rank them, and then identify the top 10, top 25 names, and those become your growth portfolio. Generally, when you see most of the fund houses which run has an aggressive value stance or a quality stance, the correlation between this factor portfolio versus the funds which have that style biases will be extremely high. So you would see those kind of correlation high in that kind of scenario, and you could find the style correlation between many of these fund houses.
Now coming to the balanced advantage fund, and different fund houses have a different way of managing the balanced advantage fund. How does Edelweiss integrate factor investing into the asset allocation strategy?
So one of the advantage of factor investing is you can apply across asset classes. It's not only about equity. You can apply in even fixed income. You can apply also in currency. You can also apply in the deciding asset allocation model. Now, when you look at the balanced advantage fund category, there are two set of funds which in the market, and people are using more factor-based investing approach to identify asset allocation. If you look at it. When you look at balanced advantage fund category, there are 35 funds which are there. And I think 95% of the funds are using valuation as an approach to find whether the equity markets are attractive or not. Now, what are you doing in this approach is that you are actually collating what is the valuation ratio of the equity market and how does it compare with the other set of asset classes, whether it is debt or XYZ thing. And then you say that which one is attractive, whether equity market is attractive or fixed income market is attractive. And if equity market is attractive, then you actually tend to push in it. It's a very similar to kind of stuff where we look at factor investing in stock market, which stock is attractive, whether HDFC Bank is attractive or Reliance is attractive. So it's a very similar approach. This is one way of doing it where you are using valuation as a matrix to identify whether equity market is attractive or not. In Edelweiss Balanced Advantage Fund, we use trend or momentum as an approach. Whether when the equity markets are doing well, we tend to focus more on equity markets. We increase allocation to equity markets. When equity markets are not doing well, we actually reduce our equity levels. If you look at it in the current market scenario, when markets are falling from October onwards, what we have seen is we have started reducing equity exposure because the equity market is showing negative momentum, and consequently we have started reducing. While contrary to that, most of the valuation-based exposure should increase equity exposure during this point of time because prices have come down, valuation have been bit more attractive. They should have increased equity. So these are two contrarian approach to that extent. The idea is that it's not the case one is better than the other. There are years when the valuation-based approach do well. There are years when trend-based approach do well. And when you look at data sets, when does this do well? Generally, when markets are trending, when markets give you positive 8, 9, 10 or negative 8, 9, 10% plus years, most of the time trend-based or momentum-based factors do very well to that extent. And when you look at India data sets for last 20 years, you would see actually 70% of time India has been in market and trending zone. So when you look at just from a probability perspective, the trend-based asset allocation model tends to outperform in the longer run as compared to valuation-based model. That's what we have seen in our studies.
Now, the Edelweiss recently listed IPO fund, it has a unique strategy. Given that many IPOs list at a premium, what's behind the fund's single-digit returns over the past 1 year and 3 years?
Okay, so great. This fund is very interesting fund. Why this fund was launched, why this fund is interesting from an investor point of view. If you look at it, IPO investing is not new. It's been there from ages and across markets. If you look at US or even any developed markets or emerging market, there are enough of IPOs which are there. It's a strategy where many people use this as a opportunity to participate in company very early. We understand if you get into a company very early at the early stage, you can make a lot of money. And I'm saying we have heard stories about people investing at IPO times at Reliance or Infosys and HDFC Bank, and people have made a lot of money. So IPO investing is very interesting proposition, and hence people are attracted towards IPO in general. Now, one of the problem with the retail investors is that how do I get an access to an IPO to that extent? That is one question. Second question which comes in, how do I select IPO? Because if you look at the history of IPOs, most of the IPOs, well, I'm just saying one third of IPOs don't make money till date, actually. Even after listing, I'm just saying so many years of history, one third IPOs don't make money. So another problem with retail investors, selection is another problem. The third problem is most of the investors, as you rightly said, and what SEBI data also suggests that they sell on the first day of listing. But in our opinion, IPO investing is not about first day listing or first day gain and some stuff like that. We have seen if you keep good set of company for a long period of time, you tend to actually outperform markets in general. Just to give you data set kind of stuff, the IPO fund last year delivered around 11% return kind of stuff till date, while the small cap, given that IPOs are generally small caps, the small cap index has given around 6% returns in the same 1 year period, implying an outperformance of close to around 5% kind of stuff as compared to small cap index. If you compare it to the benchmark, which is the recently listed NSE IPO index kind of stuff, the NSE IPO index is down, is up around 3% kind of stuff. So it's 8% outperformance as compared to 1 year. This fund has seen 6 years of track record. When you look at 6 years of track record kind of stuff, the fund has delivered around 14% return as compared to the NSE IPO index, which is the benchmark, which has delivered around 7% return. So 7% alpha when you look at since inception, 6 years of data, what we have kind of stuff. The key point in the IPO fund is that it solves the investors or retail investors dilemma how to invest in IPOs. The three problems in terms of selection, how do you subscribe to IPOs, and how do you actually harness the post-listing returns, which is very important from our perspective, because then you can gradually build position over a period, right? The listing day gain is 1 day gain, which sometimes I'm just saying it's not even substantiated in terms of it, because if you think about from a retail investor point of view, you can apply a maximum of 15,000 rupees worth in a stock. So even if the stock doubles, your wealth doesn't get created. Wealth gets created only when you build position in some of the high conviction names over a period of time. That is the only way we do. So this fund actually helps solve the three problems of retail investor. Hence, this fund is very interesting from that point of view.
But was coming specific to the large cap fund, and it has outperformed the BSE 100 in most of the time for the last 10 years, something which many active funds struggle to achieve. How has the factor investing contributed to this consistency, given the relatively narrow large cap universe? And how does the model identify opportunities? Can you share some examples to illustrate this?
Okay, so as I said, one of the important aspect in large cap is that it's a very narrow universe. As you rightly said, it's 100 stock universe. In this universe, you need to be extremely data-driven kind of stuff. Why I say is that because if you try to do an outsized position in terms of taking higher concentration risk or taking outsized based in terms of sectors, and if that doesn't plays out well, you tend to actually underperform. What we tend to do in Edelweiss Large Cap Fund is, one, we run a multi-factor model. So we are not biased towards value, quality, growth, low. So we have a mix of all factors. So that factors help you to have a consistency of returns rather than focusing on it. Second thing is we don't take cash calls in this portfolio. So we are not taking cash calls, and hence we are fully invested. So we are not vagaries of taking a wrong decision on cash calls to that extent, whether it's an upside or downside. The third thing is we want to run a diversified set of portfolio. We think the large cap fund, if you look at it from perspective, is a first investment of investor in general in equity markets, and we need to give him a better experience to that extent, and hence we want to keep this portfolio less riskier as compared to mid and small cap. So we keep it put the portfolio far more diversified to that extent. So those three things have helped this fund to deliver a consistency of performance over period of time. If you look at our return trajectory, where we have actually made a lot of money, is a lot of sectoral rotation which has happened in this fund, and this sectoral rotation in this fund has happened because of the multi-factor approach. Wherever we think the opportunity in terms of growth, quality, value, the model itself throws out these are the stock which you should be tilted towards, and that is what the sector, finally the sector outcome happens. So if my portfolio says that these are 5 companies which are showing high growth, and these 5 companies tend to be in banking or financial services, my portfolio will be tilted towards banking and financial services. So the sectoral tilts happen automatically, and that has helped actually to deliver a better alpha for a longer period of time.
Right now, before we wrap up this conversation, one last question. So, factor funds, they perform differently in different market cycles. So, given the current, dynamic market conditions, what's your advice for investors trying to pick the right factor funds for their portfolio?
So as I said, it's very difficult to identify which factors are going to do well for next year. Having said so, if you look at it, when markets are nervous, markets are weak, historically we have seen quality low all doing very well. Periods where markets are extremely volatile, momentum doesn't do well. That is one of the things which we have seen time and again in history. Value has seen a lot of outperformance in last 1.5 years, and consequently, obviously there is a averaging which happens of in general markets. So value should see some kind of breathing space for next 1 year. In our opinion, for a retail investor, the best way to approach this factor investing is through multi-factor models rather than single factor models. Single factor models tend to have a very high volatility. If the factor is in your favor, obviously you will be at the top of the charts, kind of stuff. But if factors are not in favor, typically you will be at the bottom of the chart. Retail investor would not like either of the approaches in general. They want more consistency of return, because many of these investors who are coming in the market are trying to actually outperform the inflation or beat the fixed deposits of the fixed income market to that extent, and consequently the approach is better to go through a multi-factor approach rather than a single factor approach.
All right. Well, thank you, Bharat, for sharing your insights and taking time for this interaction. It was good speaking to you. Thanks.
Thank you. Thank you very much. Thank you, Chirag. Thank you, Chirag.